For the last 15 years, I've watched the stock market turn into something it was never meant to be. A place where you could simply close your eyes, buy an index fund, and expect to double your money every 7 to 10 years. It was the golden era of passive investing. We called it the beta era, with a rising tide of cheap money and central bank intervention lifted every single boat, regardless of how leaky it was. But as I stand here in 2026, looking at the latest data from JP Morgan's long-term capital market assumptions, I have to tell you something that most people are too afraid to admit. That era is over. The index and chill strategy that built the wealth of the last generation is officially dying. And if you don't pivot now, your portfolio is going to be collateral damage. When I dive deep into JP Morgan's institutional research, I'm not just looking at stock picks. I'm looking at the fundamental architecture of the global economy. And right now, that architecture is shifting. For years, I've heard the same advice repeated over and over. Just buy the S&P 500 and wait. But the math has changed. We are entering what I call a decade of stagnation. JP Morgan's 2026 projections show that after the massive run-ups we've seen in AI and tech, valuations have hit a mathematical ceiling. The science behind this is something I talk about often. It's called mean reversion. Essentially, the market has borrowed so much growth from the future that there's very little left for the next 10 years. We are looking at projected annual returns that might not even keep up with the sticky inflation we're experiencing today. I realized recently that most retail investors are still playing a game that ended 2 years ago. They're still putting 40% of their money into bonds and 60% into stocks, thinking they're diversified. But in 2026, I see a correlation crisis that no one is talking about. When the market dips today, stocks and bonds are moving in the same direction. They are falling together. This means the old safety net is gone. My research into JP Morgan's 2026 blueprint confirms my biggest fear. If you are 100% in public markets, you have nowhere to hide. You are exposed to the same systemic risks as everyone else, waiting for a miracle that isn't coming. So, what am I doing differently? And what are the world's largest institutions doing while the retail crowd stays stuck in the past? I've decided to stop buying the market and start buying the asset. I'm shifting my focus to what JP Morgan calls the science of alternatives. This is how the ultra-wealthy are engineering wealth in 2026 while the S&P 500 stays flat. I'm talking about moving beyond the stock ticker and moving into private credit, institutional real estate, and real assets. Let's talk about private credit first, because this is where I see the most immediate opportunity. In 2026, traditional banks have become incredibly restrictive. They aren't lending like they used to. This has created a massive vacuum that I'm seeing filled by private lenders. By shifting a portion of my portfolio into private credit, I'm essentially becoming the bank. I'm lending directly to mid-sized companies that have solid cash flows, but can't get a loan from Wall Street. The returns I'm seeing here are consistently 4 to 5% higher than traditional bonds, and more importantly, they aren't tied to the daily mood swings of the stock market. It's a move toward stability in a world that feels increasingly unstable. Then, there's the world of institutional real estate. Now, I'm not talking about the old-school strategy of flipping houses or buying overpriced condos. That game is played out. What I'm looking at, and what J.P. Morgan is prioritizing in their 2026 outlook, are real assets with actual utility. I'm talking about industrial warehouses, cold storage for the global food supply, and data centers that power the AI revolution. These aren't just buildings. They are the physical infrastructure of the 21st century. The beauty of these assets is their ability to hedge against inflation. If prices go up, I can adjust the rents in real time. This is a level of control that I just don't get with a tech stock that fluctuates based on a CEO's tweet. The third pillar of my 2026 strategy is infrastructure and commodities. We've entered a new geopolitical era where tangible matters more than digital. I'm looking at energy transition assets, water rights, and logistics hubs. J.P. Morgan's data suggests that as the world deglobalizes, the companies and investors who own the pipes of the economy will be the ones who survive. It's about owning things that people literally cannot live without. When I look at my portfolio today, I want to know that I own something real, something that has a floor beneath its value. I know this sounds like a lot of work compared to just clicking buy on an ETF. And it is. But that's exactly the point. In 2026, alpha, or the ability to beat the market, is no longer a luxury. It's a necessity. If you settle for beta, or the average market return, you are settling for stagnation. I refuse to let my wealth, or the wealth of those I advise, be dictated by an index that is top-heavy with overpriced tech stocks. One thing I've learned from studying J.P. Morgan's institutional moves is that they don't care about vibes. They care about the efficiency frontier. They are constantly recalculating the risk-adjusted return of every dollar. And right now, the math is telling them to move 20 to 30% of their total allocation into these private alternatives. If the smartest room on Wall Street is doing this with trillions of dollars, why are you still holding on to a strategy from 2016? The biggest hurdle for most people is access. Historically, these alternative assets were gated. You needed $5 million just to get a seat at the table. But here in 2026, we've seen a revolution in how these assets are packaged. Through tokenization and new interval funds, I'm now able to access institutional-grade private equity and real estate with a fraction of the traditional capital. The gates are coming down, but most people are too busy staring at their falling index funds to notice the door is open. I'm making this video because I don't want you to be a victim of the retail gap. This is the gap between what the banks tell you to do and what the banks are actually doing with their own money. They tell you to stay the course and keep your money in their mutual funds because they collect the fees regardless of your performance. But meanwhile, their own proprietary desks are dumping public equities and loading up on the very alternative assets I've just described. It's time to stop being a spectator. It's time to stop letting a 60-40 pie chart from a 1990s textbook dictate your financial future. The era of easy money is over. The science of investing in 2026 requires a more sophisticated, more active, and more alternative approach. I've spent months poring over the JP Morgan LTCMA reports, and the conclusion is inescapable. The traditional retail strategy is dead. I'm not saying you should sell everything tomorrow. What I'm saying is that you need to begin the transition. Start looking at private credit. Start exploring institutional real estate. Start thinking like a capital allocator instead of a gambler. You have to decide if you want to follow the crowd into a decade of 4% returns, or if you want to follow the data into the next frontier of wealth creation. The math doesn't lie, and the institutions aren't waiting for you to catch up. I've already made my move. I've already shifted my focus to the alternatives that will define the next decade. The question is, are you going to stay on the sinking ship of the old retail strategy? Or are you going to join me in building a portfolio that's actually designed for the world we live in today? I've compiled a deep dive into the specific alternative sectors that JP Morgan is highlighting for 2026, and I've put my notes in a guide link below. This is the blueprint I'm using for my own capital. It's time to get serious. It's time to get scientific. I'll see you in the next one.